Hi everyone, I'm Benis Kumar Moses, a behavior and finance expert. Let's dive into a classic investing trap, the overconfidence illusion. It's that moment when you feel absolutely certain you've cracked the code, that you can time the market perfectly. But what happens when that certainty costs you more than the risk you were trying to avoid? Confidence is a powerful engine for success in many parts of life. It pushes us to take on new challenges and achieve our goals. But when it comes to the financial markets, overconfidence can be a recipe for disaster. We all love that feeling of being in control, of knowing what's going to happen next. The hard truth? The market doesn't care about our feelings or our forecasts. It has a life of its own. Think about an investor. Let's call her Jane. Jane was convinced she had a knack for timing the market. She'd watch the news, see a stock dip, and think, this is the bottom, time to buy. Then, when it rose a little, she'd think, this is the peak, time to sell. She was constantly jumping in and out. For a while, she even got a few calls right, which only increased her confidence, her belief that she was a genius. But soon, the market's unpredictable nature hit her hard. She sold too early and missed out on a massive rally. She bought into what she thought was a dip, only to see the stock fall further. What Jane didn't realize was the heavy price she was paying for her confidence. She wasn't just losing money on bad calls. She was also racking up hidden costs. Every time she bought or sold, she paid transaction fees. More importantly, by constantly moving her money, she was missing out on the single most powerful force in wealth creation, compounding. Compounding needs time to work its magic, and her constant trading was interrupting that process. On top of that, the emotional exhaustion of trying to outsmart the market every single day was taking a huge toll. So, what's the antidote to this costly illusion? It's a simple yet powerful concept: humility. It's about shifting your mindset from I know to I need to verify. Instead of relying on your gut feelings, base your investment decisions on solid data and a well thought out strategy. One of the most effective tools you can use is a decision journal. It's simple. Every time you make an investment decision, write down why you're doing it. What's your thesis? What data are you looking at? Then, a few months or even a year later, go back and review the outcome. Was your reasoning sound? This process keeps you honest and helps you learn from both your successes and your mistakes. Another key is to diversify deliberately, not emotionally. Don't just buy a bunch of different stocks because it feels safer. Build a diversified portfolio based on your long-term goals and risk tolerance. And perhaps most importantly, always invite a challenge. Talk to a trusted friend, seek out a contrary opinion, or work with a financial advisor who isn't afraid to question your assumptions. Getting a second opinion can be the difference between a costly mistake and a wise decision. The most successful investors I know aren't the ones who are always right. They're the ones who doubt themselves just enough to double check their work. They understand that acknowledging their limits is a sign of strength, not weakness. Remember this: the market rewards patience, not prediction. Stop trying to time the market and start spending time in the market. That's where real, sustainable wealth is built. Thanks so much for watching. If you found this helpful, please give this video a thumbs up and hit that subscribe button for more insights into smarter investing. See you in the next video.